Taxes. Fun, fun, fun. There are two major tax systems we have to deal with. One is the income tax system, which most people are familiar with, and the gift and estate tax system, which most people have to rely on their advisors to understand. Income taxes. As Lee said earlier, dying doesn't get you out of paying taxes. If you died, as she said, the example she gave, I'll just stick with it. If you die June 30th, your executor or administrative trustee has to file your final tax return, which is due April 15th, the year after death. So if you could go to the slide and scratch through October and write April. If you are a surviving spouse, you can still file a joint return for that year. And it's required if there's reportable income. For the income earned after date of death to the end of the year, that income now shows up on a trust or estate income tax return. And trust and estates use a form 1041 instead of a 1040. The way income is in a trust or estates, the income and deductions are very similar to what individuals can use, but who pays that tax is in the hands of the trustee. If the trust decides to keep taxable income, the trust will pay tax on it. And if the trust distributes that income out to the beneficiary will pay tax on it. And just to get this straight in your heads, none of this applies while you're alive for your living trust. Because your living trust is revocable, it's ignored for income tax purposes. But after your death, it becomes irrevocable and it becomes its own taxpayer with its own tax ID number. An estate can have a fiscal year. You don't have to just go from, say, June 1st to December 31st. You can pick a different month to end the year. And that can be advantageous by pushing back when taxes are due. You can actually gain, if someone died in December, you can gain 11 extra months before having to pay those taxes. The tax return for an estate or the administrative trust is due annually for as long as that estate's open. And if your trust then creates sub-trusts, whether it's a family trust for a spouse, a marital trust for a spouse, or trusts for the kids, each of those trusts become their own taxpayers and will be filing taxes annually. Estate taxes. Estate tax is not a tax on income, it's a tax on the value of your stuff at the time you transfer it to someone else. The current exemption is $5 million, actually $5.12 million, and you only have to file a 706 if you're over that threshold. A 706 is due 9 months after date of death. If there's taxes due, the taxes are due at that time. You can extend the filing of the return by 6 months, but not extend the date of payment. This should be filed if you're over the threshold, even if the spouse is the major beneficiary and no taxes are due. There can even be advantages to filing a 706 if you're not required to at all. Because, as Lee mentioned earlier, at date of death, there's a new tax basis for income tax purposes in those assets. The only way you can have certainty with the IRS of what that value is if a 706 is filed and the statute of limitations runs on their ability to question the values at date of death. So if you have a family business in the estate and you go and have it appraised but you don't file a 706, and 10 years later that family business is sold by the kids and they're going to claim the basis at date of death, the IRS could actually challenge that basis because that value's not been made final by the expiration of an audit period.
Excuse me, what's a Form 706?
Form 706 is the estate tax return. It's essentially a balance sheet return that lists the value of all the assets of the decedent.
Okay, thank you.
Again, for 2012, the exemption's $5 million, $5.12 million. That is part of what was a 2-year extension back in 2010. Those laws are set to expire December 31st, 2012. If Congress doesn't do anything, the exemption drops back to $1 million per person. The current rate of tax is 35% on the overage over $5 million. That rate of tax could actually climb to 55% on everything over $1 million. Another interesting thing they did is this year there's a thing in the law called portability. That $5 million exemption is actually inheritable by your spouse. So if you die penniless, your spouse could file a 706, the estate tax return, and actually claim your exemption. And then the surviving spouse's exemption jumps from $5 million to $10 million for 2.5 months. We've not, in our planning, tried to rely on portability because it has not been in a law that's permanent. If it becomes part of the permanent law, we may reassess it. But there's still advantages to using the family trust model versus relying on just the tax code to save taxes. Annual exclusions is another way to help drain an estate, bring an estate down to avoid estate taxes. You can currently give as many people as you want $13,000 every year. I keep waiting on my check from Bill Gates, but it hasn't shown up yet. That number is actually slated to increase next year. It is it's indexed for inflation. Next year we're going to hit where it's going to become $14,000 per person that you can give away without any gift taxes. Because of the high exemption, the real risk that the exemption drops, the real risk that the rate of tax climbs for high net worth individuals, the next 2.5 months is a very key time to consider doing some estate tax planning. Gift taxes. Gift taxes are filed annually if you make gifts in excess of the annual exclusion. So if you give someone this year $13,001, that's more than $13,000, so you've generated a requirement to file a gift tax return. If you're serving as someone's executor or administrative trustee, one of your duties is to make sure all tax returns are filed. Not only have they filed all of their income tax returns, but you have to look over their lifetime history of gifting and make sure they've filed all their gift tax returns. Now, a lot of that may be difficult to spot, but you could at least look through the property tax records to see if real estate was transferred as a gift. In fact, the IRS is currently in an audit initiative where the IRS is perusing Register of Deeds across the country to find transfers, interfamily transfers of gifts that were not reported on gift tax returns. There's a question in the back? Yes.
Patrick, I have a question about if you transfer funds over to educational 529 accounts for your great-grandchildren, do you have to file a separate tax return for each one of those accounts, or does it depend on how you set that up?
The question is, if you make multiple gifts, do you have to file multiple gift tax returns in the same year? And if it's 529s, what are the special rules around that? With 529 accounts, if you're making gifts, you have the option to elect to borrow your next 5 years of annual exclusions. So don't make me do math in my head. Let's just pretend for a moment the annual exclusion is $10,000 per person. So if I put $50,000 into a 529 for my child, I can file a gift tax return, check a box, and treat that as annual exclusions over the next 5 years. Now, it will have actually used my annual exclusion for that child, say next year. I can't then give them another $10,000. If you make gifts to a bunch of people in the same year, all those gifts are still reported on just the one return for that year. Any other questions? Yes?
Assuming I previously, my wife, what are the tax consequences of the assets that I leave?
Tax consequences on inheritance by a spouse is essentially the question. When a spouse inherits assets outright, there's a thing called a marital deduction. So if you have a $100 million estate and you leave it all to your spouse, there's no taxes. Now the result of that is we took it out of the decedent's estate and we added it to the surviving spouse's estate to be subject to estate tax later. which is why many of these, your living trusts will have some tax planning in it, concepts like a family trust, marital trust, so that some of the assets go into a trust bucket that will capture your exemption. Because if you just give everything to your spouse, you didn't use your own exemption. It got wasted. And so we only have one exemption at the surviving spouse's death to use to shelter against estate taxes. What the family trust bucket in your plan will do is capture assets that up to your exemption amount. And this year with the $5 million exemption, lots of our clients, all of the assets would go into that bucket. And then that is a bucket of assets that at the surviving spouse's death is excluded from the tax base. So let's just say, as an example, we go back to 2000, in 2013 it goes back to $1 million, and you've got a couple worth $2 million. They each own $1 million. If they just give everything to each other, the survivor dies with $2 million, $1 million more than the exemption, and pays $500,000 in taxes. If instead there's this family trust, marital trust tax planning in their plans, the first spouse dies, their $1 million goes into the family trust, the surviving spouse later dies, only with $1 million, because the other $1 million's out here outside the system. They can use their own exemption to cover that $1 million, and there's now zero tax.
Thank you.
You're welcome. Any other questions on taxes?